The market has realized that, and it's been acting like it, fast, messy, and with zero respect for anyone who thought this was going to be a smooth ride. Tuesday, February 10th. Not because miners are safer, they're not, but because if you understand the setup, there are moments when miners behave like a lever on the metals and moments when they behave like a trap door. We're going to build a framework so you don't just chase symbols like a tourist chasing pigeons. All right, let's start with the crash because that's what everybody's obsessed with. Now, from recent tape action, we didn't just drift down. We went from everything is fine to where's the exit in a heartbeat. Gold had been flirting with that big psychological level, 5,000 an ounce, while silver at one point was printing numbers that would have sounded ridiculous not long ago, north of 100 an ounce. And then, almost on cue, the air came out. You could see it in real time. The bids got thin, the spreads widened, and the vibe shifted from greed to survival. That's why people call it a crash. It feels like gravity suddenly got heavier. And here's the part. Crashes don't happen when everyone is cautious. Crashes happen when people are comfortable. So, if you're wondering why now, the answer is usually because too many people were leaning the same way at the same time. And if you want a simple mental model, it's this. When a market is trending up, leverage is a tailwind. When it snaps, leverage becomes a guillotine. Same tool, different direction. So, when you hear that the sell-off was about sentiment, I'd argue it was more about structure. What happened was not mysterious. It was violent, but it wasn't magic. We had a run that got crowded. We had paper positions stacked on top of each other, and then we got the thing that always shows up at the worst possible moment, stricter collateral rules. From recent market updates, the exchange that clears a lot of the big precious metals contracts has been hiking margin requirements again and again. And if you've never traded futures, margin is basically the bouncer at the door. It decides how many people can stay inside the club. When the bouncer suddenly raises the cover charge, a lot of people get kicked out, not because they want to leave, but because they can't afford to stay. And here's where it gets ugly. If you're levered, a small rule change is not small anymore. People hear a couple points and they shrug. But if you're running, say, 10 to 1 leverage, that couple points can turn into find a big chunk of cash right now or sell. And they don't sell because they change their mind about silver. They sell because the system demands it. So the crash, in part, was a mechanical event. And that matters because mechanical events don't tell you the long-term story of supply and demand. They tell you about who was over their skis. Now, some people jump from that to, see, it's all manipulated. And I get why people say that. There's history here. There have been real enforcement actions in the past against big institutions for games and metals markets. That's not a conspiracy theory. That's in the public record. But I want to challenge one assumption that's floating around. Not every margin hike is some secret handshake. Sometimes it's boring risk management. When volatility explodes, clearinghouses don't have the luxury of being romantic. They have to make sure the system survives the next day. So yes, question incentives always, but also don't get hypnotized by one explanation because markets usually have more than one engine running at the same time. And that brings me to the bigger point. The crash was loud, but the bigger storm is quiet, and it lives in credit. And if you think I'm exaggerating, just look at how the conversation has shifted lately. For years, it was all about stocks and crypto and easy money. Now, quietly, the yield chase has moved into private deals. But the trade-off is always the same: liquidity. Public markets let you hit a button and get out. Private credit often doesn't. So, when stress hits, people discover they own something that's priced like it can be sold tomorrow, but behaves like it can't be sold at all. That gap between what people believe and what the product actually is can turn into forced selling elsewhere. Again, that's where metals get dragged in, even if they didn't cause the problem. Let me paint the picture. We've spent years with people treating credit like oxygen, cheap, everywhere, invisible, and now we have this massive chunk of lending that sits outside traditional banks. Private credit, direct lending, private debt, call it whatever you want. It's not new, but it's much bigger now, and it's spreading into places it didn't used to reach. Based on the latest publicly available reports, the private credit world is no longer some niche side hustle. It's measured in the trillions globally. And what matters isn't just the size, it's the structure. Because the way a lot of these deals work is simple. Money flows from people who want yield to entities that promise yield, and then that money gets lent out to borrowers who can't or won't get the same terms from a regular bank. And that's fine until it isn't. The risk is opacity. The risk is liquidity mismatch. The risk is that you don't know what's inside the box until the box gets dropped. And here's the part that should get your attention. Big banks are not separate from this. According to recent systemic risk discussions, banks have exposures to non-bank players through lines of credit, derivatives, financing arrangements, prime brokerage, you name it. The number floating around in policy circles is in the multiple trillions. And the key issue isn't whether the number is exactly this or exactly that. The key issue is direction. It's big, it's grown, and it's intertwined. So when people ask me, what does private credit have to do with silver? I say everything. If the unwind turns disorderly, because if credit cracks, the first thing you see is forced selling. People sell what they can, not what they want. They sell winners to cover losers. They pull liquidity out of anything that has a bid. And metals, especially silver, are volatile enough to become a cash machine for margin calls. That's why you can have a situation where the long-term story still looks bullish, but the short-term tape looks like it's trying to throw you off a horse. And recently, we got a real-world reminder of how quickly these low-volatility credit products can re-prick. A large, widely held middle-market lending vehicle publicly flagged a sharp markdown in a single quarter. Call it high teens. And the market reacted like it had been lied to, because in a way, it had not necessarily by fraud, by optimism, by smoothing, by the assumption that loans are always worth close to what you paid for them until the day they're not. Now let's be careful here. One fund marking down doesn't mean the whole system is collapsing tomorrow. But it does tell you something. Marks can move. And when marks move, leverage gets uncomfortable. And then you add derivatives. And this is where the domino metaphor shows up. But I'm going to use a different one. Derivatives are like electrical wiring behind drywall. If it's installed well, you don't notice it. If it's installed badly, you don't notice it until the house smells like smoke. Credit default swaps, total return swaps, all these things, they can move risk around. They can also concentrate it. And the hard part is that gross numbers look terrifying and net numbers look calm. And the truth is often hiding in the difference between the two. So I'm not here to say derivatives equal doom. I'm here to say in stress correlations go to 1, liquidity disappears. And the stuff you thought you could hedge sometimes becomes the thing that hedges you right into a wall. Now, one more bridge here, because this is where people get blindsided. When credit cracks, the political response is rarely elegant. It's often reactive. And the first reaction is usually, we have to stabilize the system. That phrase can mean a lot of things depending on who's holding the pen. Sometimes stabilization means liquidity, sometimes it means guarantees, sometimes it means mergers, and sometimes, this is the one nobody wants to talk about, it means shifting losses. In Europe, we've already lived through the playbook where depositors in a troubled banking system took a haircut above a certain threshold. In one famous case, it was close to half, not a small fee, a real hit. And the lesson wasn't never use banks. The lesson was in a crisis. Rules can change quickly, and what you thought was untouchable can become negotiable. In the US, after the last big crisis, lawmakers built a framework for resolving large failing financial firms without a classic taxpayer bailout. The language is dry, orderly resolution, liquidation authority, that kind of thing. But the concept is simple. Equity gets wiped, certain creditors eat losses, and the system tries to keep operating. That's good for stability. But it also means the discussion of who absorbs losses doesn't go away. It just moves around the chessboard. So when I talk about confiscation, I'm not talking about one cartoon event. I'm talking about a spectrum of policy responses that all have one thing in common. They try to capture resources from wherever the least resistance is. Now, why does this matter for confiscation? Because in a real credit accident, governments don't usually announce, "We're confiscating your gold." They do something more subtle. They change rules, they change taxes, they change access. And that's what I mean by modern confiscation risk. People get hung up on the dramatic version, the knock on the door, the order, the seizure, the old story from the early 20th century when the monetary system worked differently. And yes, historically, there was a period when people were ordered to turn over gold. That happened. But the setup back then was very specific. The currency system was tied to gold in a way it isn't now, and the gold was centralized in places that made compliance easier to enforce. Today, the landscape is different. Ownership is distributed, storage is private. The incentive for a nationwide door-to-door hunt is weak, and the political cost would be ridiculous. So Tier 1 hard seizure is the least likely in my view. But here's the cliffhanger. The least likely scenario is not the least dangerous because the more likely scenarios don't look like confiscation when they happen. They look like policy. Tier 2 is taxation. And I don't mean normal taxation. I mean opportunistic taxation. The kind of taxation that shows up when an asset becomes a symbol. If gold and silver do what a lot of people think they can do in the next phase, if they become dinner table topics again, politicians are going to notice. And if the broader public doesn't own much of it, the political resistance to taxing it is low. That's just reality. We already know precious metals can be treated differently for tax purposes than stocks. In the US, for certain forms of metals exposure, the tax treatment can sit in the high 20s on long-term gains before you even talk about extra surtaxes or state layers. So the baseline is already heavier than what many people expect. Now imagine the next step, a windfall-style framing, not because they hate you personally, but because they need revenue and they need villains. And you don't have to like that. You just have to be awake to it. The playbook is simple. Set a reference price, call anything above it excess, and skim. People will clap because they're told it's fair, and because, frankly, most people aren't in the trade. And I know somebody's going to say, well, then I'll never sell. Okay, but life sells for you sometimes. You sell for a house. You sell for a business. You sell because you need liquidity. And when you go to turn an asset into spending power, that's when the system can take its bite. Tier 2 also shows up at the state level. And I want to be very precise here because there's a lot of noise. There are proposals and ballot initiatives floating around in big states about wealth taxes aimed at ultra-wealthy residents, billionaire-type thresholds. Whether those pass or not, the direction is the story. The direction is governments are experimenting with new ways to tax balance sheets, not just income. And some of those proposals talk about what happens when people leave. That's where the exit tax conversation comes in. As of now, in some jurisdictions, there isn't an enacted broad exit tax the way social media describes it. But the fact that it keeps being proposed tells you what's on the menu. And this is where I'll challenge a different assumption. Some people say they'll never do this because rich people will leave. True, some will. But governments don't need everyone to stay. They only need enough people to not leave fast enough to fund the next year. Policy doesn't always optimize for 10-year outcomes. It often optimizes for the next budget cycle. So don't assume bad policy won't happen because it's bad. Bad policy happens all the time. That's why it's called policy. Now, Tier 3, the end game. And again, I'm going to be careful because people scream CBDC and then their brain turns off. Here's what we actually know from official statements. In the US, a central bank digital currency has not been adopted, and the central bank has said it would need legal authorization to move forward. There are also politicians pushing in the opposite direction, trying to block it, and there are people overseas moving ahead with their own versions. So the timeline is not guaranteed, but the concept matters, because even without a full CBDC, the direction of money is toward more digital rails, more reporting, more compliance, more gating. And if you think that won't touch metals, I think you're underestimating how the system behaves when it wants to manage flows. Programmable money doesn't have to mean a science fiction switch that turns your wallet off. It can be simpler, it can be friction, it can be delays, it can be reviews, it can be please provide documentation, it can be a transaction flagged because it touches something considered sensitive. So imagine this. You own metal. You go to sell, you expect cash. But instead, you receive digits that come with rules. Maybe the rules are mild at first. Maybe it's just reporting. Maybe it's automatic withholding. Maybe it's a waiting period. Whatever it is, the effect is the same. Your ability to move from metal to spending power becomes conditional. That's the modern form of confiscation, not taking the metal, making the on-ramp and off-ramp narrow. And if that sounds paranoid, let me ask you a simple question. Do you think future governments will want less visibility into money or more? Drop your answer in the comments. Do you think the bigger risk is taxes or payment controls? Now, all of this sounds heavy, so let's pull it back to what you can actually do. First, don't let fear narrative shake you out of a position you took for a reason. Volatility is the price of admission in silver. It's not a bug. It's the feature that throws people off right before the next leg. Second, think about where your risk actually lives. If your silver exposure is all paper claims in a system that can raise collateral overnight, just be honest with yourself. You're playing the game inside the casino. That doesn't mean it's wrong. It means it has rules you don't control. Third, and this is where miners come in, understand leverage. Miners are businesses. They have costs, they have politics, they have geology. And in a rising metal environment, a miner's profit can change faster than the metal price itself, because costs don't move one for one with price. If your cost per ounce is relatively steady and the selling price jumps, your margin expands like a spring. That's why miners can outperform on the upside. But here's the cliffhanger. That same spring snaps on the downside. A miner that looks like a hero in a bull tape can look like a bankruptcy candidate in a risk-off week, even if the metal only pulls back modestly. So the question is not which miner will go up. The question is, which miner can survive the bad weeks without you getting forced out at the bottom? So let's build the checklist. Number 1, cost discipline. You want operations that can produce at cost that leave a healthy gap even if the metal takes a punch. Costs that are too close to the metal price turn a mine into a coin flip. Number 2, production trend. Is output stable to growing or is it shrinking? A shrinking producer is like an ice cube in the sun. It looks fine until it doesn't. Number 3, jurisdiction. Where the rocks live matters. Some places are predictable, some places are not. And it's not just about risk. It's about timelines, permits, royalties, community relations. One signature can change your whole model. Number 4, balance sheet, cash, and manageable debt. Because if you're carrying heavy debt into a volatile metals market, you're not investing. You're juggling knives. Number 5, stage. Producer versus developer versus explorer. Producers have cash flow. Developers have dreams and paperwork. Explorers have hope and drill results. Each has a different risk profile, and you size them differently. And I'll add a bonus one because people forget it. Number 6, share structure and dilution risk. If a company constantly issues new shares to fund its plans, you can be right about the metal and still not make money. Your slice of the pie keeps getting thinner. So always look at how management funds growth, not just what they promise. Also, keep an eye on sustaining versus growth spending. Some mines look cheap because they're underinvesting. Then one day the bill comes due, and the low-cost story disappears. And here's a quick aside. A lot of people obsess over grades like it's the only thing that matters. Grade matters, sure, but grade without metallurgy, grade without recovery, grade without infrastructure is just a number on a slide. The market learns that the hard way over and over. So when you're evaluating, try to imagine the whole path: discovery, engineering, permits, financing, building, ramp up. Each step has a different kind of risk. And the reason developers can be 10 baggers is the same reason they can go to zero. They're crossing a minefield with a blindfold and a map that might be outdated. Now, with that framework, let's talk names. And I'm not telling you to buy anything. I'm giving you a map so you can do your own homework. On the lower risk end, again, lower is relative. Look at established producers like Alamos Gold. They've been putting out guidance that points to meaningful growth over the next few years, and they're doing it by building out projects they already control rather than chasing shiny objects. That matters. Another one to watch is Fortuna. Even though people call it a silver name, a big chunk of its economics is tied to gold, and it's operating across more than one region. Diversification helps, but it also adds moving parts, so you have to watch execution. Then you've got a smaller, more concentrated story like Galliano tied to a major operation in Ghana. Turnarounds can pay, but single asset risk is real. The company has been talking about drilling and future updates that could change how the market values the asset. That's where the upside comes from and where the disappointment can come from too. Now, if you want the higher risk, higher upside bucket, you move into developers. Newfound Gold is one people talk about because the grade headlines are attention-grabbing, and the company has been moving pieces on engineering and financing with the stated goal of a first pour in the back half of 2027, pending permits. That pending word is doing a lot of work, but if you're building a watch list, it belongs on it. Vista Gold is another developer-style option tied to a large project in Australia with ongoing work to align permits and engineering to a newer plan. These are long-dated trades. You don't buy them because you need action next week. You buy them because you want an option on development in a world where capital flows back into real assets. And then for silver leverage, New Pacific is one of the names people circle because of its large Bolivian projects and the ongoing work to move them forward, including dealing with local issues that can derail a project. Bolivia has history, so you don't ignore that. But you also don't ignore that big deposits in a silver bull can turn into magnets for capital. So here's the way I think about it. If you want stability, you lean producer heavy. If you want torque, you sprinkle developers. If you want lottery tickets, you go exploration, and you size accordingly. Now, let me add something that doesn't get said enough. Even in a bull market, you need a plan for profit taking, because the retail pattern is predictable. People hold through big gains because it feels good, and then they hold through ugly drawdowns because it feels temporary, and then they sell when it feels hopeless. Don't do that. Have rules. It can be as simple as trimming into strength or raising stops or taking back your original capital when the market gives you a gift. The goal isn't to be perfect. The goal is to stay in the game. And if you've ever been through a full cycle and you manage to actually lock in gains, tell people about it. If you're successful, share your success story in the comments so others can stay motivated. Now, before we wrap, I want to circle back to silver itself because there's one more layer here that's getting a lot of attention: the physical inventory conversation. You've probably heard people talk about how much deliverable metal is sitting in exchange vaults versus how much paper is outstanding. And yes, there are official warehouse reports that break down categories like registered and eligible. The key point for you is this: only a slice of inventory is actually tagged as ready for delivery. Recently, that ready slice has been sitting a little over 100 million ounces, give or take, depending on the day. And open interest can represent multiples of that in notional claims. Now, does that automatically mean a default? No. And you should be skeptical of anyone screaming guaranteed default on a schedule. Exchanges have tools. Cash settlement exists. Rolling exists. Incentives exist. But here's the cliffhanger. The tighter that deliverable slice gets, the more fragile the paper game becomes during a squeeze. And the more fragile it gets, the more violent the price action can be, both up and down, because the system is trying to balance promises with metal. So, the crash we just saw, that could have been a pressure valve. It may have flushed weak hands and reduced leverage before the next delivery window. Or it could have been the first crack in a story that's going to force a repricing later. Which one is it? That's the question. And I want you to comment this too. Do you think the next big move in silver comes from industrial demand or from a paper position unwind? And that's why I keep saying the crash was just the beginning. Because the next phase isn't about a chart pattern. It's about stress tests on clearinghouses, on credit marks, on liquidity, on policy. If the private credit world keeps expanding and a recession scare shows up, you'll see the marks move again. If the marks move again, you'll see collateral tighten again. If collateral tightens again, you'll see forced selling again. And somewhere in that loop, silver's going to do what silver always does: exaggerate everything. So, here's my ask. Don't just watch price. Watch the conditions around price. Watch margins. Watch credit spreads. Watch headlines about liquidity and stability. Those words are usually the smoke before the fire. And if we get another one of those sharp downdrafts, don't panic. Ask, was it a change in the long-term story, or was it the system clearing leverage? Because if it's the second one, the next move can surprise you. If you got value from this, subscribe. Short and simple. It helps the channel, and it tells the algorithm we should keep doing this. All right, take care, and I'll see you next time. And just to be crystal clear, this is for education and discussion only. I'm sharing how I think about markets, not telling you what to buy or sell. Do your own research. Consider your own situation.